Hello and good morning, listeners. It's good to be back, and I'm just back from Mahakal Nagri, and I should say, people of MP, क्या बड़ा दिल लेके आए हो यार, इतना बढ़िया मेहमान नवाजी. And I'll just begin by saying Jai Shri Mahakal, as you all say. This is Almus Market Mornings with Shikhar Garg, folks, and our FM just released the budget. It did turn out walking on the tightrope, efficient enough by the first looks, as they are as it was found supporting the consumption, all the while also pushing for a capex, a few changes on the tax regime sides for the common man as well. So JK, I'd like you to put some light out there on the budget, but at the same time, folks, we had the FOMC meeting yesterday, and it was something the markets were keenly waiting for, as the Fed hikes the rate by 25 basis point and continues to maintain that they are going to have another two in the lineup. Now, what's interesting was to see the statements falling on deaf ears as they continue to mention that the case for 2023 rate cuts is still far off. And yet, we saw dollar index falling, euro strengthening, GBP strengthening, and rest of the currencies also finding some strength against dollar. So, JK, what's your thought? It's a heavy day. What should we be doing in the markets?
Good morning, Shikhar. Uh, so yesterday's budget, in fact, nothing to fault with the budget as far as the uh, impetus for consumption and the growth of the domestic economy is concerned. In fact, immediately after the budget presentation was over, I heard many analysts giving it 11 out of 10 mark for the way it was, planned out. However, the stock markets have been dealing with things which are other than the macroeconomy, and a lot of turbulences related to corporate groups, valuations, etc., have been behind the moves, and the impressive recovery in the market after the big sell-off earlier in the week, in fact, got reversed after the budget, as investors found strength to sell into. So that actually spoiled the sentiment for the rupee as well. If anything, these recent events have ensured that the rupee remains decoupled from the global dollar trend. Though we remain in a narrow range between 81.50 and 82, it displays a bias to weaken more. But for that, we need to break and close above 82. From the rupee perspective, definitely budget was a disappointment as well, because it made no effort to address our high CAD, improve the flows, though one may say that emphasis on higher growth through record investments may eventually lure long-term foreign investors. We will continue to see the rupee move independently, taking cues from the domestic factors and flows. And even today's drop in crude prices by nearly 3%, at least in the short term, is unlikely to make a big difference to the rupee's fortunes. Yes, on to the FOMC, which was the big event that was on the radar. The biggest takeaway from the statement, along with the widely expected 25 BP rate hike, was that Fed opted to leave ongoing, rates on course within the formal language, and indicated that there were more tightening moves to be realized in these cycles. And for those looking for, the day to present a pivot, further increases in the target band meant it is still soon to look for the Fed to shift to a hold stance. But markets looked at it with a dovish eye, ignoring Powell's statement that the labor market was still out of balance, and that Fed had a different view from the market and did not see cutting rates this year. On the other hand, the same dovish eye gave weightage to his statement that that the Fed had covered a lot of ground, and his observation that wages moving down, and they expected to see the disinflation process will be soon in on the core services ex housing, although it was not yet seen. And Powell's statement that they would update assessment for rate hike path in March meeting was also taken to mean by the market that there was no clear commitment on the next rate hike, which is once again read as a dovish sign. So all in all, while Fed or Powell did not intend to pass on a dovish message, market was inclined to take a dovish view of the same, and that reflected in the market action later, and it to several a big reversal in stocks from negative to modest positive, treasuries being bought with 10-year yields tumbling 12 bps and 2-year by 15 bps. At the after the press conference, money markets are actually betting on a terminal rate of 4.892% compared to 4.92 just before the statement. And the futures were pricing in rate cuts this year, with Fed funds rate being seen at 4.403 by the end of December. Quite a contrast to what the Fed has been trying to message. The market's initial reaction to Fed statement, of course, as I said, was to sell stocks. But as the conference moved on, stocks were bought back. Nasdaq, in particular, gained 2%, continuing its strong performance carried over from January. Also, investors would have been encouraged by the weak ADP numbers coming at 106,000 from 253,000 in November, and further drop in ISM manufacturing index, while at the same time ignoring that the prices component was actually higher in the ISM index. But definitely ISM index remaining contraction territory for the last 3 months is making the investors feel that the economy is sharply slowing, and that the Fed cannot hold on to rate hikes for much longer. The US dollar accordingly went lower in conjunction with lower yields and strong risk appetite. DXY off the best part of 1% on the day, although from the highs it was more than 1.5% lower. Euro move has been much more impressive than others, with the single currency making a new cycle high. That was enough to bring USD index closer to 100.81 from the high of 102.50 on the day. But we would put down Euro's rally more to ECB rate hike prospects, which is expected to move from the current 2.5% to 3.75%. And this is happening at a time when the market is trying to discount a pause or even a rate cut by the Fed. So there is a divergence between ECB expectations and the Fed expectation. That itself has been supporting Euro to a great extent. ECB will hike 0.5% today, despite a lower reading on headline CPI, although core inflation remains still high and not dropping. S&P's global manufacturing final reading was higher in the Eurozone, and it rose almost in all the states. We have a BOE meeting ahead of ECB, and they are also expected to hike by 0.5%. Although their economy is not showing such strong signs as the Eurozone economy, the market will look for clues as to the future rate prospects in UK, depending on the reading of the economy by the central bank. We have a lot more data from US economy today, like jobless claims, challenger job cuts, factory orders, and Q4 productivity. But the major events will, of course, be ECB and BOE meeting and tomorrow's monthly jobs data from the US. While on the dollar, gold has taken a very impressive path, than other major currencies. It has been steadily interspersed with healthy corrections. So that is making the rally more sustainable. Even as the reports indicate buying interest from central banks, and we look for gold to head towards 1980 immediately, although continued drift lower in yields can see it tie the all-time high at 2050. But contrastingly, despite a weakness in the dollar, oil prices slid $3 per barrel on Wednesday after US government data showed big buildup in crude oil and gasoline inventories, and the Brent futures were down 2.6 or $2.6 or 3.5%. And even OPEC deciding to stick to their output policy had its impact on pushing the prices down. So all in all, dollar weakness sustains, and good support for this trend, although technical readings currently look a bit stretched. And at the same time, I would also like to point out that some of the Asian currencies are quite a bit stretched because the moves have come in very short period of time. Just to give you a perspective, South Korea logged its biggest monthly trade deficit ever yesterday at 12.7 billion. And that is something that may not comfort the central bank, because all said and done, while the dollar may be weak for its own reasons, export-led economies cannot withstand huge strength in a very short period of time. So maybe we get some sort of support for the dollar from the EM side very soon. Thank you.
Okay, JK, that was quite good and detailed, as we always see you giving out good commentaries. Folks, as JK mentioned, INR continues to be decoupled from the USD, and the strength in dollar or the weakness in dollar has not really given too much of influence on the INR strength or weakness. But as JK mentioned, the budget, although by a lot many critics was lauded, it was a bit disappointing on the currency side, as there was nothing really strong enough for the bond side and for the capital flows to be lured into the nation. But as we see, Fed was also found starting on with the narrative of disinflation, and uh, the dovish sentiment or the dovish stance by the Fed was something which pushed dollar index on the lower side, pushing again new cycle high for the euros, while other majors also strengthened. It can also be said that euro pushed for the new cycle high majorly on the backdrop of the ECB rate hike prospects. Even though the core inflation remains high, there has been other data points which kind of looked strong enough for the eurozone. So it's still to be seen how things go ahead with the ECB meeting. But all in all, USD weakness sustains. Markets are still looking for cues on how to move about, and as you mentioned, EMs can be finding the support for the dollar index soon enough. That's it for today, folks. We shall come back again tomorrow with another round of updates as the market continues to release a lot many things on daily basis. Thank you so much for listening.